Gene, have we seen trade effects yet? I mean, this is a big debate. Market economists measure it to the 100th of a basis point. But at Pimco, have you actually seen real, tangible trade effects?
I think we've seen very little in the actual macroeconomic data. But I do think it's part of what's been affecting markets this year. It's been affecting currencies. It's been affecting confidence. So if you were to ask me relative to the start of the year, what has happened to emerging markets, had you not had this trade uncertainty, I think you would have had far better performance, both from a growth standpoint and from an equity fixed income standpoint. So yes, it's had effects.
Patrick, within the effects of the trade agreement, it simply comes down to the back and forth and the acrimony as well. It does seem tangible. What's the outcome of the next step of a trade war? If we get further tariffs, what will that do?
Well, tariffs are essentially a tax on the consumer. And U.S. economy is 70% consumption. You've got higher oil prices right now. That's a tax on the consumer as well. So I think that's a net effect, is just it's a tax and a burden. And the U.S. is the consumer of the world. So I think that's where they feel it on the consumer side of things. The tariffs on the other side of the equation are on the exporting countries. It hurts their profit margins and hurts growth. So I think different types of countries feel it differently. A tax if you're a consumer, and a margin headwind, and maybe even a volume headwind if you're a producer.
But, Patrick, is it really a trade war, or is it just talk of a trade war?
It's getting close to a trade war. I'd still say it's not a trade war at this point. It is, and I think the market's rejoicing on the Chinese numbers right now. I think we should remember that these numbers just came out pre the tariffs really now, so people were buying in advance of potential tariffs, and that may even be giving it a little bit of a boost that I think the market might be getting a bit of a false joy right now and see the consequences in the coming quarters.
Okay, that's interesting. Do you think that actually the Fed will look at numbers, looking at trade, and will already see an impact, and so therefore delay its hiking?
No, I think the Fed's behind the curve already, actually. I think 2 years ago, when Yellen had to hike or delay the hike because of the global backdrop, the U.S. is in a very different situation right now. 2 years ago, U.S. inflation was running at 1%. Now we're getting close to 2 on the core, 2.4 on headline CPI. Unemployment down below 4. I think the U.S. can look at its own economy right now and doesn't have to worry about unsettling the rest of the world. It's got enough economic momentum, and I don't think we're at a crisis point anywhere in the world the way we were a couple of years ago.
What about you, Gene? Do you think the same?
Yeah, I mean, I would agree with a lot of that. I would say that, to the extent that tariffs are coming into effect, it does increase inflation risks. Unfortunately, it's stagflationary risk, where there's downside risk to growth, upside risk to inflation. It doesn't make the Fed's life any easier. I also think, it does add to this notion that we need more risk premium in the bond market. We started to see term premiums move last week. We think they probably need to move more. There's just a lot of uncertainty.
Okay, but a lot of uncertainty that will play out how in the markets? I mean, uncertainty that will kind of be more fixated on the 6 months, or that can last? I mean,
we talked briefly about credit and high yield and the resilience of high yield. I mean, I would say the same thing about credit that Patrick said about equities. We think high yield and credit generally are pretty overvalued, so we want to be very cautious with those. We think, you're at a point in the cycle where you should start to see volatility go up. That is bad for credit. On the other hand, I think on the emerging market side, that's where you see at least a lot of these risks better discounted. That doesn't mean EM is cheap per se. It's just better discounted for the risks at hand.
Gene, what do you do on a Friday? I want some advice on how to allocate cash now. Do you sit in cash, or is there something Pimco can do this morning with cash?
Yeah, I mean, I think you get paid quite a bit to be in short-dated fixed income. There's still a reasonable amount of steepness at the front end of the curve, and for taking very little duration risk, you can basically be in very liquid instruments. But against that, we also recognize, and again, it's to one of the earlier points, this trade war so far is a phony war in a sense. I mean, it could get ugly, but it may not, and Trump may turn on a dime and suddenly we have a trade deal and everything looks pretty good. To the comments of your earlier speaker, global growth is actually pretty strong right now. So that means we actually want to look for things which we think are, discounting a more extreme negative trade scenario, like in the emerging markets, and actually be long those things. So maybe it's a little bit of a barbell where, a little bit toward cash and a little bit toward the stuff that's really gotten hammered.